Ever feel like you're working hard, but your money isn't? Like you're missing out on a secret to building real wealth? What if I told you that you could own a tiny piece of companies like Apple, Google, or Amazon and profit as they grow? That's the power of the stock market. And it's not just for Wall Street experts in fancy suits. It's for you. In the next 20 minutes, I'm going to demystify investing. No jargon, no confusion. Just a simple, step-by-step guide. We'll cover what the stock market is, why you should care, and exactly how you can make your very first investment. Even if you only have $100 to start. Stick around, because this could change your financial future. So, what exactly is the stock market? Let's forget the complicated charts for a second. Imagine your favorite local coffee shop. It's so popular, the owner wants to expand and open more stores. To raise money for that expansion, the owner decides to sell tiny pieces of the business. These pieces are called shares or stocks.
Now you can buy one of these shares. When you do, you become a part owner of that coffee shop.
If the coffee shop does well and its profits grow, the value of your share goes up.
You could then sell your share for more than you paid for it. That's a profit, or what investors call a capital gain.
The stock market is just a giant, global marketplace where you can buy and sell these shares from thousands of public companies. It's not a physical place anymore. It's all done electronically, right from your phone or computer. And companies aren't just coffee shops. They're the businesses that make your phone, your car, your clothes. By investing, you're essentially betting on the future success of these businesses and the economy as a whole.
Now, you might hear about indexes like the S&P 500 or the Dow Jones. What are those?
Think of them like a report card for a big group of stocks. The S&P 500, for example, tracks 500 of the largest US companies. If you hear, "The market is up today," it usually means the average value of the companies in these major indexes has increased. It's a quick way to get a snapshot of how the overall economy is performing.
Okay, so that's what it is. But why should you personally invest your hard-earned money?
The number one reason is to build long-term wealth. Simply saving money in a bank account isn't enough.
And that's because of a sneaky wealth destroyer called inflation.
Inflation is the rate at which the cost of goods and services increases over time. Your money buys less tomorrow than it does today.
A typical savings account pays very low interest, usually much less than the rate of inflation.
This means the money you're saving is actually losing its purchasing power every single day.
Historically, the stock market has provided average annual returns that are significantly higher than inflation.
This allows your money not just to keep up, but to grow substantially over the long term. This is thanks to the magic of compound interest, which Albert Einstein supposedly called the eighth wonder of the world.
Compounding is when your investment earnings start generating their own earnings. Your money starts working for you.
A small amount invested today can grow into a massive sum over decades, without you lifting another finger.
Investing is your best tool to fight inflation and build a nest egg for your future goals.
Whether that's buying a house, retiring comfortably, or achieving financial freedom.
Convinced? Great. Now for the practical part. How do you actually do it? I'll walk you through 5 simple steps.
Step 1. Choose a brokerage account. This is the account you'll use to buy and sell investments.
Think of it like a bank account, but for stocks. It's where you hold your money and your shares.
For beginners in most countries, there are many low-cost, user-friendly apps.
Look for one with zero commission fees on stock trades and a low or zero account minimum. Do a little research, read some reviews, and pick one that feels right for you. The sign-up process is usually quick and easy. Step 2. Fund your account. Once your account is open, you need to transfer money into it from your bank account.
The important thing is to just get started. Don't feel like you need thousands of dollars to be an investor.
Step 3. Choose your first investments. This is the part that scares most people, but it doesn't have to.
As a beginner, you don't need to pick individual stocks. In fact, it's often better if you don't.
Remember the S&P 500? An S&P 500 ETF is a single fund that you can buy like one stock. But it automatically spreads your money across all 500 of those top companies.
This gives you instant diversification. If one company does poorly, it has a very small impact on your overall investment.
You're not betting on one horse, you're betting on the entire race. This is one of the safest ways to invest in stocks long term.
Search in your brokerage app for a low-cost S&P 500 ETF. Common tickers are VOO, IVV, or SPY.
Step 4. Understand order types. Before you click buy, you'll see two main options, market order and limit order. A market order buys the stock immediately at the best available current price. It's simple and fast.
A limit order lets you set a specific price you're willing to pay. Your order will only go through if the stock hits that price or lower. For beginners buying long-term ETFs, a market order is perfectly fine. Don't overthink it.
Step 5. Place your first order. This is the moment of truth. Decide how much you want to invest. Many brokers now offer fractional shares, which means you can invest by dollar amount, say $50, instead of buying a full share.
Review your order one last time and click that buy button.
Congratulations! You are now officially an investor. You own a piece of the largest companies in the world.
Principle 1. Be consistent. Don't just invest once. Make it a regular habit, like paying a bill.
Set up automatic transfers and investments into your brokerage account every week or every month.
This strategy is called dollar cost averaging. Sometimes you'll buy when prices are high, sometimes when they are low. Over time, it averages out your cost and reduces the risk of investing a large sum at the wrong time. Principle 2. Think long-term. The stock market is not a get-rich-quick scheme. It goes up and down daily.
Don't panic when the market drops. This is normal. It's called volatility.
Remember, you're investing for 5, 10, or even 30 years from now. The short-term noise doesn't matter.
The worst mistake you can make is selling in a panic when the market is down. That's how you lock in losses.
Principle 3. Keep it simple and diversified. You already did this by buying an index fund ETF.
As you learn more, you might be tempted by hot individual stocks or complex strategies. Be careful. For the vast majority of people, sticking to low-cost, diversified index funds is the most reliable path to wealth. Don't check your portfolio every day. It will drive you crazy. Check it once a month or even once a quarter.
Your job isn't to outsmart the market. Your job is to be consistent, be patient, and let the market work for you over time.
And that's it. From understanding what a stock is to making your very first purchase.
You now know more about investing than the vast majority of people. The secret is out, and it's simpler than you thought, right?
The most important thing you can do now is take action. Open that account, transfer that first $100, and get your money working for you.
Your future self will thank you for it.
And for more simple guides on personal finance and investing, make sure to subscribe and hit that notification bell.
I have a question for you. What's the one thing holding you back from investing? Let me know in the comments below. I read all of them.